There's spectrums of being active. But in the passive side, sure, it's cheaper, but passive markets means you're performing just like the market.
Right.
If the market goes down 20, guess what?
Exactly.
You're down 20.
What do you got behind you over there?
You know, today we got some good old Neil Diamond.
All right.
I can honestly say I just picked it because it matched the background color. I don't know much about Neil.
Oh, well, we may have to have a little education on Neil.
I know Madonna, who you have today with us.
Well, look, I mean, I feel like Madonna is one of those artists from the early 90s where if you liked Madonna, people would look at you and be like, what's wrong with you? We have like, you know, Kurt Cobain and all these other artists that are grungy and popular right now. But look, you can put that album on start to finish and go for a run and hear really great running songs basically on the entire album.
I feel like that's really gotten lost. Like people like songs now, they don't really like albums. That's my maybe a hot take about music is I listen to songs. There's a few albums though that when I can go start to finish, complete game changer.
Yeah.
That's what makes a good album for me.
So actually, now that I'm old enough and secure enough in my own non-toxic masculinity, okay, that I'm comfortable saying, like, I like that album.
Fair enough.
Okay, 30 years ago, I may have had to say that in a hushed tone, but, like, I like all the songs on that album.
Well,
so there you go. I think it's a classic.
It has to be. So,
and I heard that she jumped up and performed at Coachella recently.
Oh,
Yeah.
see, everyone's coming back around. Like a big circle, I think, is the funny thing here is music is really circular. And
right.
I think it actually is a great way to move into our topic today because we're going to be...
The comeback of Jordache jeans? No.
Oh,
okay.
maybe not that.
Okay.
But we are going to talk about a time-old, something that I think is basically almost beaten to death.
Okay.
But there's a lot of things that we can say about it that I think are going to be helpful for people.
Drum roll. What's the topic?
Is it better to be an active or a passive investor? The old active versus passive debate.
Okay.
It's come up again, I think, even more so as you get platforms like Robinhood or Schwab or all these now platforms that are designed for do-it-yourself investors, retail investors.
Right.
And there's been a lot of change in how investments are delivered.
Okay.
You know, and I say this, we use them all the time, so I think it feels like they've been around forever. But ETFs, is exchange-traded funds, are a great way to kind of invest in the broad market. Before, you used to have to only buy individual stocks. There were no funds or there were expensive tax inefficient vehicles like mutual funds.
Right.
ETFs now allow you to tax efficiently and for a low cost, just buy the market. And when you're being a passive investor, you buy those kind of funds and you just hold on to them. You're not trying to do better than the market. You're not trying to do worse than the market. You're just trying to be the market as cheaply as you can.
Right.
I think a lot of people think that that is maybe a better strategy than the more traditional, what people are, I think, familiar with, what's called active management.
Mm-hmm.
Active management is when you have an intent of trying to beat the market. So you're taking active decisions to look different.
Right.
In hopes of, hey, I might outperform, but you also might underperform. It's a big decision that investors are making, I think, is what kind of portfolio do you want?
Yeah.
And what kind of outcome are you hoping for? So I think when we look at those two terms, being an active or passive investor, what are some of the costs and benefits that you've seen, I guess, in each of those categories? Like you can pick where you want to start, whether it's passive or active.
So, okay, I don't think there is a one is right and one is wrong, right? So there are shades of gray in there, right? I think the thing about active management that trips investors up is when they have an active management strategy that's based on behavior and impulse and news cycles and what they see Cramer talking about and things like that.
Good old Cramer.
I think if you're actively trying to manage a portfolio yourself, you in that avenue, you end up with a couple different things. You end up with wildly overvalued stocks where you're getting in at the top, or you're getting into emotionally charged stocks, or, and this is the silent killer, the overconcentration, right? So I'll use an example that everybody will relate to, but it's sort of it's a tired routine here, but the Mag 7, right?
Yep.
So people would be like, oh, I keep hearing about NVIDIA and I keep hearing about Microsoft. I keep hearing about Apple and they're great companies. And you think about like Peter Lynch back in the 90s. I think one of his books may even be up there. But, hey, just buy what you know kind of mentality. Buy the things you use on a daily basis. If you drive Ford cars and you're familiar with the model lines and all that stuff, buy what you know. I think you can end up in a concentration scenario where things can really get away from you really quickly. And so my experience with that can really be, there are multiple experiences, but here are two that will resonate with everybody. The .com era.
Sure.
Right? Because everybody was loading into all the stocks they were going up. They really, really were until they weren't. And then when they weren't, everybody had the mentality of, I've seen this before. I've seen these sell-offs before. This, it'll come back. It'll come back. It'll come back. And the next thing you know, the pets.com puppet is dead.
Yep.
So things like that, and actually some really, really good companies thrown in there as well. So people will have a difficult time with the concentration risk on the active management. Now, there's another component of active management, which is, hey, listen, have you employed a professional to run an actively managed strategy where you are looking at economic information, you're looking at earnings information, and you're trying to find those 20 stocks or so, whatever, X number, and trying to find the stocks that actually are going to perform very, very well. And you're actively either buying and holding them or actively watching them or actively selling them when something comes up. And the pros to that are there will be periods of time where your outperformance is greater than the market. And then there will be periods of time where it's not as good as the market. And what the common perspective on that is, 80% of all active managers fail to outproduce or outperform the index. I think what it fails, that looks at it on an annual basis, but what it fails to do is look at it over a 20-year time horizon. Yeah. Right. So there, I think that an active management strategy is great, but like pistons in an engine, the only one-cylinder engine that exists in the world is on your lawnmower, right? And we all know how noisy that thing is. There are no one-piston cars because they're not smooth enough and they don't accelerate correctly and they don't get good gas mileage and things like that. So you think about an 8-cylinder engine. Yeah. I suppose there's people out there who still buy a 4-cylinder engine, but 4, 6, 8, 12 even, right? The whole idea there is I'm going to stick with the 8-cylinder engine. Okay. This is good. I can go all the way back to the 60s with an 8-cylinder engine, right? Some of our car enthusiast clients will appreciate this. Pistons are going up and down and in various stages of going up and down over the cycle of an engine. Correct.
Over the whole journey, the longer term periods.
So when you step on the accelerator, the pistons go up and down faster and the car accelerates. But the car is literally accelerating from 0 to 60 with pistons that are going down and pistons that are coming up. So some are not contributing to the forward motion of the car and some are contributing to the forward motion of the car. But when you average those 8 out, you push the accelerator, the car goes to 60 miles an hour pretty smoothly, right? Yeah. So I think if you think about active investing as one of the cylinders or 4 of the cylinders or even 6 of the 8, sure. Right? I mean, as long as you're spreading the active management component, the pros and cons out over some other pistons as well, it's great. I think an active management strategy is a great component to any well-diversified long-term investing strategy. Sometimes it's going to do well. Sometimes it's not going to do well. And in the bucket of active management, there are different styles of active management.
Exactly. So, right. And I think, too, another thing is it's important to call out the costs. I mean, if you're doing all this work, like you said, of looking at fundamental data, looking at market trend data, right, it's going to cost more. But that doesn't necessarily mean cost the bad thing, because cost isn't the only thing that is going to lead to being, a good outcome or a bad outcome. Right. It's, can the cost justify what I'm receiving? Right. And a big piece of it, like you talked about, Dave, is with it going up and down, up and down, up and down, those periods of under and out performance, sometimes that's a really tough strategy for people to stick to, if I'm being honest. Right. And if you bail out at a bad point, you're not going to maybe get to that outperformance point in the future. So if you're trying to be an active investor, you got to realize you're kind of having to take your time And you're going to have to ride a little bit of that as the market moves.
Right.
And as investment styles go in and out of favor. So those are some of the costs, I think, of being an active investor, which, to your point, I think we'll get into it here in a second. There's spectrums of being active. But in the passive side, sure, it's cheaper, but passive markets means you're performing just like the market.
Right.
If the market goes down 20, guess what?
Exactly.
You're down 20.
And the other side of that, let me stick with the active, but bring me back to the passive thing, because I have a point there to make about boredom. Okay, so remind me, because I'm 58 and I'm starting to lose my short-term memory. I want to talk about the boredom aspect of passive investing. But back to the active investing real quick. I think when investors evaluate the performance of an active manager, they can inappropriately look at it in the short term of saying, this active manager didn't outperform their benchmark this year, so I'm going to get rid of them and replace them with somebody else. That's a very common refrain that you'll hear from both advisors who their business model is to actively manage those active investors and be sort of like the man in the middle and the consultant, be like, well, I'll
just pick other people to run the portfolio.
Right, exactly. And you're outsourcing the actual selection of Coke and Pepsi, but you're insourcing the actual, I'm going to monitor the managers.
The decision of who you're investing manager is.
Here's where that becomes a problem. If you have invested in active managers and their sole mandate is to outperform the benchmark that they're assigned to outperform, you may find yourself getting very frustrated on an annual calendar year basis. A better way to go about that is to look at this and say, do I or do I not subscribe to the philosophy and the process that they use to run that active management strategy? So if the mandate is outperform the benchmark, I think there's a problem with that. If the mandate is, hey, listen, I am hiring you as a manager to manage my, pick the asset class, large cap growth,
dividend,
or dividends, or small cap value, or whatever it is, international. That's not the best example in the world, but we have enough to make the point. I think you need to understand what their process is for managing that portfolio and agree ahead of time that the process makes sense and that you're comfortable with what are the good and bad components of that process in a down market, right? And then when you evaluate whether or not you want to continue on with that manager, should be in the context of, I don't think their process works, or they're not adhering to the process. It shouldn't be, hey, it's December 31st and they underperformed their benchmark by 3 percentage points, not inclusive of fees, and I'm going to can them. I think that active management is really important to understand what the process is that they use to run the portfolio, and you either subscribe to it philosophically and process-wise, or you do not. And if you do subscribe to it, you got to understand that there are going to be times when those strategies are not performing in line with the market, and you've got to just own that. You've got to be like, okay, I get it.
There's no silver bullet when it comes to investment. If there was a perfect strategy that had no downside risk or times it didn't work, everyone would be in it.
Exactly.
It's literally that simple. But guess what? Each investment strategy is going to have times it works, times it doesn't.
That's right.
And I think one thing at Monument, we do all of our investment management basically with our asset management team. We have our own strategies. We're not relying necessarily on someone else to run an investment strategy and stick to it, because we have our own processes that we know we are sticking to.
Right, and we've built them
from scratch. And going all the way back, I think, to when you started Monument, almost 18 years ago, 20 years ago.
Well, and even beyond that, before we even started Monument, running these kind of processes and refining them over time, right? Like, I'm getting a little bit off track. I'll come back to the topic, but since you mentioned it, let me just clarify that the models have a maturity component. Like, I mean, they have matured over time. The model that we use right now to run the 20 stock growth strategy is not the same model that we built 20 years ago. It's matured. It's progressed. We have discovered, like, this works better than that, and it's always being refined. It's a living model.
It is, and I think, but the core always is there, right? Exactly. You're building around the same core, and I think that's always what about active management that I've seen in my career that always makes me a little hesitant of sometimes using that manager selection of it versus actively managing it myself. you kind of got to have a lot of trust that the manager is going to stick to their strategy.
Right.
And I've seen it, and I know probably a lot of people are saying, well, of course they're going to do it. They said they were going to do it. They built their whole business. I've seen it. I've seen it not only once, I've seen it a handful of times, is all of a sudden you look at the manager's strategy and you're like, well, hold on, you're supposed to be buying dividend stocks. Why are you owning Bitcoin?
Right.
Because they're trying to get that, to your point, that return bogey. Now, this is where I'm going to remind you, passive, the boredom effect of passive. Let's talk about passive a little bit.
So in a previous podcast, we used the example of 401k plans where you have a very limited choice of what your investment style is, and you tend not to look at it very often because you can't, if you're in your 30s, you're not going to have it for 30 years and that kind of thing, right? You can't have access to it. So you tend not to look at it, you be like, oh, I can't have that money for 30 years anyway, so I don't even look at it. That's a really healthy mentality that people have about their 401k plans that they don't necessarily extrapolate and apply to their other portfolios.
The other investing that they're doing, right?
And another great example of that is when parents or people set up 529, I'm just going to stick with parents. Parents set up 529 plans for their kids. And if they set up a 529 plan when they're a year old, they're not going to need or even be able to have, I'm going to use college as an example. So they're not going to need to fund the college expenses until their birth year, 18 years old, and call it 21 or 22 years old.
Correct.
Right? The first dollar will be at 18 and the last dollar will be at 22 if they're in 4 or 5 years of college, right? Okay. So when you look at the performance of a 529 plan, which doesn't have you can't just go in and buy NVIDIA in a 529 plan, right? They're super boring. When you wake up 18 years later and your kid's about to go to college, you're like, wow, this thing's returned 10% a year annualized after fees. And you're like, yeah, because you didn't mess with it. It was a passive investment. Nobody's looking for casino-like action in the 529 plans, right? People get drawn to the flashing lights and fresh oxygen in their trading portfolios. And that's where the boredom thing actually becomes a very difficult thing to manage, because if you just took the money and put it in, there's all these charts that say, if you invested $1,000 in the S&P 500 index all the way back, look at what it would be worth now. Pick any period of time, as long as it's greater than 10 years, there's some sort of positive return, right?
Yeah.
So when you look, but that's boring. I mean, who wants to sit around a cocktail party and talk about SPY? Right?
Well, it's when your brain gets in the way
That's
of,
right.
Not your brain, sorry, your heart gets in the way, or in your gut of the brain.
Or FOMO or any of that.
But I think you brought up the perfect point, is because the big ETF out there that a lot of people buy for just broad market exposure is SPY.
Right. And that tracks the performance of the S&P 500 index pretty closely.
Yeah.
And it's low cost.
Low cost. I'm not trying to beat the market. I'm trying to be the market.
Right.
Well, if you look at the returns of that SPY ETF over, to your point, a 10-year period, and you compare it against, let's say, if you look at it up at Morningstar, you'll see that they put different categories. So other large cap blended kind of investment managers, you're in the top 18th percentile.
Right.
Meaning you're better than, to your point again, I think a lot of the world and all those people who are trying to maybe be a little bit more active by just staying invested. But that's not easy.
Right.
That's not easy either, because there's plenty of studies, and we've talked about them in previous episodes, about staying the course is hard because you either get bored, you start chasing shiny things, or you panic.
Yeah.
And really, that's why, again, even if you're doing passive investing, the markets are still going to drive your returns. You can't panic in order to get the successes or maybe the benefits of passive investing. Active managers, and why I think when the way we monitor and try and run portfolios, during periods of declines, they're usually trying to limit losses but capture gains, right? Most active strategies have some component of that. How they do that, million ways under the sun.
Right.
So when you think about it, again, you still just have to be invested. Whether you're passive or active, I think, like you said, there's maybe a blend of both.
Yeah.
Because even in the active space, so let's talk about, again, the different types of active management. There's some that are more active than others. How active can you stomach is really, I think, the question that everyone needs to ask.
And let's not forget to weave in the specter of taxes in how active can you be, right?
Yeah. So I guess that's another thing too, because active trading can sometimes lead to into tax inefficiencies.
Exactly. Especially when you hear people talk about day trading or constant trading, any turnover, let's just call it turnover, okay?
Sure.
Whether it's daily as a day trader or even you trade something 359 days after you buy it, right? Anything inside of a 12-month holding period is going to be taxed differently than anything that you hold for 12 months in a day or
Correct.
12 months period. Anyway, you get my point. So the taxes can be twice as much on the active strategy that is trading and turning over is really the term.
Mm-hmm.
Inside of 365 days, your tax rate could conceivably be twice as much as a active strategy that's trying to be tax efficient by holding things for 365 days.
Yeah.
So there's that factor too. That specter exists. And sometimes you forget about that when you see, oh, I doubled my money on something. Well, okay, yeah, pre-tax.
Yeah.
Okay.
But still, even if you did double something,
Mhm.
I would rather get out of it before I gave up that doubling.
Oh, yeah, right.
Right. So you can't let that taxes be the only factor driving your investment decisions. But that's where some of the trade-offs come in again.
It's a trade-off.
And
right.
different account types, like if you're trading in a taxable portfolio, there's all those tax implications. If you're doing these kind of active strategies with high turnover in retirement accounts, there's no taxes to be paid on that kind of increased trading activity.
Yeah.
So it all is like this big sliding scale where we do see, I think, on the taxable side of clients or an investor's money,
Right.
tax efficiency matters way more than I would almost rather have an active strategy that has the potential maybe to outperform the market over the long term.
Sure, as long as it's not a one-piston engine.
Correct. But you have that balance throughout your whole financial life.
Right.
That's why it's holistic.
Let's pat ourselves on the back and brag about ourselves a little bit.
Okay.
Because I'm going to introduce a new topic, which is one of the things that we like to do here is actively manage passive investments.
I love that saying.
Right, yeah, because that's essentially what we're doing. So for people who are driving down the highway and going the speed limit and being very careful and not texting and you're just listening to us talk about this, actively managing a passive investment means like you can actively manage ETFs. You can say, hey, large cap growth is doing better than small cap value. Right? So you can actively choose to be in large cap growth and actively choose not to be in small cap value and then own the ETF to do that.
Yes.
So, and one of the things that I think is really attractive about it, there are other people that actively manage passive investments.
Yep.
I just invented it. Okay. Okay. Like, right. I am the godfather of actively managing passive. Okay. No, I'm kidding, obviously. But I think that actively managing passive investments has a couple other things. You can be tax efficient, fee sensitive.
Yep.
Because those passive investments are pretty cheap.
Correct.
Okay. And you can be globally diversified.
Yeah.
So again, to just use our exchange traded fund strategy as an example, because clients are probably familiar with it if they're listening to it. And it's easy to explain for somebody that's not invested in it. But if you're actively managing those passive investments, you have a component that is domestic US, and then you've got the international, and you can break that international down into developed markets and emerging markets. And then instead of just being in one passive investment, like, for example, the ETF, EFA, which just tracks the performance of the developed countries, you can break that down into different countries.
That's what the value is for me.
You can be in Germany, you can be in Italy, you can, and then in the developing markets, you can be in things like Poland and Israel and Turkey or Turkey, however they want us to pronounce it these days. So, but that's really what's fascinating about it. But you're still in these tax efficient, fee sensitive, and globally diversifying a portfolio, all while actively managing those passive investments. Because again, when you choose an active manager, you got to understand their philosophy. So because this is an active strategy, you've got to understand the philosophy, which is, hey, we want to be in the things that are doing well.
Yep.
And not in the things that aren't. It's not like if everybody can close their eyes and think of a tic-tac-toe box with 9 squares in it, that's kind of how you can think about the big size and style investment allocations. Large cap growth, large cap value, large cap blend. That's your top part of the tic-tac-toe box. And then mid cap growth, mid cap blend, mid cap.
Same.
Right. And then small, right? So you got 9. A lot of asset allocators will say, well, we're going to have a passive strategy and we're going to have a little bit of everything. So we're always guaranteed to be in something when it's working. Okay, that means you're always guaranteed to be in something that's not working.
Yeah.
And that gets to your point, which is it can be difficult to behaviorally be in something that's not working.
Well, and I think it's just being really intentional in this kind of strategy that we operate here. And I think we probably should cut another episode sometime down the line here about specifically how we decide which parts are working and don't work.
Right.
But for this conversation, I think, again, the developed markets is a great example because you see places in the world that aren't doing as well. Maybe it is Japan, for whatever reason, is not doing well. And, but Korea is. Or, or Germany is, to your point. But avoiding the parts that are kind of dragging you down, sure, maybe that someday they'll recover, other parts turn over. In a passive investment, you're kind of accepting that you're going to have winners, you're going to have losers, and they're going to average out. By actively managing passive funds, you're really trying to focus on that winner's space. And still, to your point, be cost sensitive. There's a lot of ETFs out there that are starting to be what are called active ETFs. So you can just buy an ETF, and it's the same thing as buying like an active management strategy through a mutual fund or working with Monument. But sometimes those fees on those funds, those internal expense ratios, they're very high.
Yeah.
So you got to, it's more about how can you blend it together. And that's, again, why I like our core ETF strategy, the one that you were talking about. It is fee sensitive, but it's actively managing those passive funds. You get the benefit of the passive funds,
right?
But also you get some benefit from that active management too.
Right. So for example, in our ETF portfolio, we do not have any exposure to small cap growth because it's not really working that well right now.
But we did earlier this year.
But we did. And and we shifted into mid cap value. Why? I don't know why mid-cap value was working better than small-cap growth. It just is.
Yeah.
And so from a philosophical perspective, from a process perspective, if you just say our process is to be in what's working and not be in what's not working, it doesn't really matter why. And it's fun to talk about.
It is.
Don't get me wrong. Like I'm not being flippant. I'm not.
But that's why we have the podcast, because we talk about why parts of the market might be doing better than the other. But at the end of the day, and we're going to definitely cut an episode, I think, going into the Monument thought process of how we measure that. So stay tuned for that one. But I think, again, to maybe bring it full circle, active management is about understanding the process and knowing not only when is it going to work, but when is it not going to work. And understanding that you got to ride out through all those periods.
Right.
Because if it's a bad active strategy, it's never going to work. But, but then they're going to shut down their business and they're not going to be around anymore.
And here's a great example to kind of make the point. I don't know how many people are getting on CNBC and talking about mid-cap value. Okay. But you want to know what I know? Mid-cap value ETF is up 10.3% year to date.
Yeah, as of end of April 22nd.
Right. Anybody talking about why? No. But there's a ton of people on CNBC talking about big cap stocks. And if you look at the Russell 1000 Growth Index and the ETF that corresponds to that, it's only up 81 basis points this year. So it's like nobody's talking about the things that are working, but if you have a mechanism and a process for identifying what's working and you're in it and you're not in the things that aren't working, well then, I'll pull up size. You make your point while I pull up size and style.
But I think it's even more broad than that. Like you said, it was CNBC talking about that. No, CNBC's active management is really looking at, and I call them active managers because they're trying to say, I think this company is going to go up to this price over this time frame based on these reasons.
Right.
Not to be the flippant point again, but if it's a stock, I've seen good stocks go down in price. And I've seen what I think are bad stocks go up in price.
Right.
But really what matters at the end of the day is, again, how you're, from an active management standpoint, are you willing to take the risk of maybe being different than the benchmark?
Right.
Just if you're okay being different, that can be a good thing. But again, it's a broad spectrum. How different do you want to be? Do you want to be in stuff that is completely different than the benchmark of whatever your benchmark is?
Right.
Because if you're a dividend investor, you should have a dividend benchmark. Or do you want to be stuff that is more like the benchmark, maybe more cost efficient?
Right.
And that's really the decision you have to make as an investor. It's not black or white. It's really balancing your whole portfolio to have exposure to both. Because there's times active management works, there's time it doesn't.
Right.
And it just takes more time and effort, and that's why it costs more to be an active manager.
Yeah.
So that's really, I think, at the end of the day, if I leave people with kind of one thing, that's what I would like them to have.
Yeah. I think I will summarize my commentary with this. if you think about investing in the international space versus the domestic space, right? The international space has not been in favor for a long, long time.
Yeah, people who are calling for it to always come back for that long, long time.
And sometimes the problem with deep value is it can stay deep value for a very long time while other things are going up.
If it looks cheap, it might be cheap for a reason.
Right, and stay cheap.
Correct.
Which is like, hey, there's some great companies in the emerging market, in the developing market space, international developing market space, but they just haven't really done anything. Even though they're great companies, they just really haven't done anything. So when I sort size and style year to date, okay, the emerging markets index, as tracked by the ticker EEM of the ETF that tracks as a whole the emerging markets index.
Yeah, it's the passive version if you're going to just buy the emerging market stocks.
Yes, up 15.6%. Okay, but what inside the developing markets is actually contributing to that performance, right? Whereas conversely, the SPY, which is essentially the S&P 500, up year to date 4.35%. Okay, so that's a pretty significant delta between year to date returns. But if you go back over and look at if you break the emerging market space down into countries inside of emerging markets, and I'm just going to talk about some of the ones that we're in, right? But emerging markets, you've got Taiwan, Poland, and Brazil, okay, up year to date. Taiwan's up 35% year to date. Poland's up 12% year to date. And what was the third one? Brazil. I mean, I don't know who's talking about Brazil, but it's up 28%.
Yeah.
So you can own the EEM and be up 14, 15%.
Yep.
But if you look at what's working inside that index and be invested in that, that's actively managing the passive investments.
Correct.
However, you don't want a lawnmower engine.
Yes.
Right? You want an 8-cylinder engine. So one component can be actively managing passive investments. Another cylinder could be actively managing growth stocks, dividend stocks, REITs and business development companies, direct indexing.
Yep.
All of that. And when you combine those things all together, you get the performance of a V8 or a V12 versus a 2-stroke Honda lawnmower engine.
And it helps you stay invested.
Right.
Again,
exactly.
I say this all the time, and I it's my broken record line. I think I have to say it. It's just hard. And so by having different types of strategies that work, it helps you navigate the market swings.
Exactly. So like a prayer, everything's doing very well. But the reality of it is, every single year you're going to look at something and say, that sucks.
Yeah.
And it may suck for a couple years.
Yep.
But one day it won't suck.
No.
Like EEM.
Correct.
Like emerging markets.
Yep. You can call for it ever. But,
exactly. So.
Well, Dave, as always, great conversation.
Yes.
Really do appreciate the dive into what, again, is the age-old question. Should you be an active or a passive investor?
Yes.
Yes. Simple as that.
Right. So, and one of the things, this is not one of our traditional Ask Monument Anything episodes, but I will say to people that if you do have questions for Monument, you can ask, I'll let Nate give the email address, but you can email us, you can get on LinkedIn, you can get on our Instagram account, you can call us, anything you want. If you have a question, fire it off to us. We'll suss it out and we will answer it on a future, not that this is an Ask Monument Anything, but I like to make a good plug for Ask Monument Anything because we like to answer the questions.
Yeah, and that email is offthewall@monumentwm.com. So.
I didn't want to steal all your thunder.
It's all right.
Giving the email address is kind of like, that's the cookie, man.
Of course. Thanks. I appreciate it. But as always, thanks for tuning in.
Yeah, thanks.
The content presented by Monument Capital Management LLC is intended for general informational and educational purposes only. No portion of this content should be construed as the receipt of or a substitute for personalized investment, financial, legal, or tax advice. Monument is neither a law firm nor an accounting firm, and no content should be interpreted as legal or accounting advice. Any discussions of investment strategies, financial planning concepts, or related topics are general in nature and may not be appropriate for every individual or situation. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment strategy, planning approach, or discussion referenced will be profitable, suitable, or successful for any particular person or circumstance. Past performance is not indicative of future results. From time to time, this content may reference hypothetical situations, illustrative examples, or stories that do not involve actual Monument clients. These scenarios are designed solely to illustrate concepts or demonstrate how Monument might approach similar situations and should not be interpreted as endorsements, testimonials, or guarantees of any particular outcome. No two clients, situations, or experiences are exactly alike, and results will vary. Nothing discussed should be interpreted as a guarantee that any client or prospective client will experience a specific level of results or satisfaction if Monument is engaged or continues to be engaged to provide investment advisory services. Monument's investment advisor's registration status or any prior experience should not be construed as an assurance of future performance or success. Copies of Monument's current Form ADV Part 2A, Disclosure Brochure, and Form CRS, which discuss our advisory services and fees, are available upon request or at www.monumentwealthmanagement.com/disclosures.